Nobody shows you the bank statement. They show you the trade, the green candle, the entry, the exit, the percentage. They never show you what the account looked like the month before that trade or the 6 months before that. They never show you the deposits. They especially never show you the withdrawals. The bank statement is where the real story lives. This is what Forex traders' accounts actually look like at every stage of growth, from the first deposit to the point where the money works without them. Stage 1. You've been in the market for less than 3 months. Your account balance is $847. You funded with $1,000. $47 of that is already gone across 14 trades in the first 11 days. You don't have a strategy yet. You have an approach. It changes based on what YouTube video you watched last. This week it's support and resistance. Last week it was the RSI. The week before, a guy on TikTok showed you a moving average crossover that he said never fails. It has failed 4 times since you started using it. Your position sizes are inconsistent. One trade you risk $12. The next you risk $80 because you're trying to recover the $12. That second trade is called revenge trading. You don't know that term yet. You will. You've made 3 winning trades. You remember all 3 of them in detail, the entry, the exit, how it felt. You've made 11 losing trades. You remember those too, but differently, as near misses, bad luck, things that would have worked if you just held a little longer. This is not accurate, but it is universal. Every trader at this stage rewrites history the same way. The ESMA, the European Securities and Markets Authority, requires regulated brokers to disclose what percentage of their retail clients lose money. The figure printed on broker websites right now ranges from 68% to 82%. Those are accounts that never leave this stage. They reload, they try again, they reload one more time, and then they stop. Your statement at stage 1 doesn't look like a trading account. It looks like a slow leak. Stage 2. You've been trading for 8 to 14 months. Your account balance is $2,300, but that number is misleading. You've deposited $4,100 total across 3 accounts. The first account you blew in month 2, overlevered on a news event, 51 GBP USD went the wrong direction and moved 180 pips in 4 minutes. Gone. You funded a second account with $500. That one lasted longer. You were doing well for 6 weeks, up 18%. Then you gave it all back in 1 week when the market entered a range, and your trend-following system stopped working and you kept taking the same setup anyway. You funded a third account with, well, $200. That's the one sitting at $2,340 today. You know things now. You know what a risk-reward ratio is. You know you're supposed to risk 1% to 2% per trade. You do this sometimes when you're calm, when you've slept, when the week is going well. When you've had a loss and you're emotional, the position size creeps up. This is where most of the damage happens, not in the system, but in the deviation from the system. Your win rate is around 44%. That's not bad. The problem is that your average win is $67 and your average loss is $94. The math on that is slow, grinding destruction. You haven't worked out the math yet. You feel like you're almost there. You are not almost there. The gap between stage 2 and stage 3 is the graveyard of Forex traders. FPFX Tech analyzed over 300,000 prop trading accounts and found that only 14% of traders who attempt a funded challenge ever pass one. Most of those who fail aren't failing because they can't read charts. They're failing because their math is broken and they don't know it yet. Stage 3. You've been trading for 2 to 3 years. You just passed your first Firmo challenge. Your funded account is $10,000. Your personal account is $1,500. Something changed in the last 6 months. Not a new indicator, not a new strategy. You stopped adding things and started removing them. You went from 5 indicators down to 2. You defined exactly what a valid setup looks like for you, not in general, for you specifically, and you started taking only those setups. You started keeping a trading journal, not to look at it later. To force yourself to write down why you took every trade before you took it. That one habit changed everything. Your funded account is $10,000. The rules say you can't lose more than 5% in a day and no more than 10% total. You treat those rules like physical walls. On 3 occasions, you've closed trades early at a small loss because you could feel yourself approaching the daily limit and you knew your judgment was degraded. 2 of those trades would have recovered. 1 would not have. You don't know which is which. That's exactly why you closed them. Last month, your funded account returned 3.8%. That's $380 on a $10,000 account. With an 80% profit split, you took home $304. Your personal account, where you take slightly more risk, returned 4.2%. That's $75.60 total income from trading last month, $379.6. You still have a day job. You need the day job. But for the first time, you have a number on the board, a real number, not a screenshot of a lucky trade. An end-of-month withdrawal that hit your bank account, $379.60. You remember the exact date it cleared. At stage 3, the bank statement has stopped being a source of shame and started being a scoreboard. The score is still small, the direction has changed. Stage 4, you've been trading for 3 to 5 years. You manage 3 funded accounts totaling $130,000 in capital. Your monthly withdrawals average $3,200. You pass the FATMO challenge, then a MyFundedFX challenge, then an E8 funding account. All 3 run simultaneously on the same strategy with slight variations in position sizing to account for the different drawdown rules. Managing 3 accounts at once requires discipline that most traders at earlier stages don't have. You schedule your trading sessions, 6 a.m. to 9 a.m. during the London Open, 2 hours in the evening if a setup is forming at the New York close. Outside those windows, you don't trade. Not because you can't. Because you've tracked your data and you know that your trades taken outside those windows have a negative expected value. The data told you to stop. You stopped. Your win rate is 51%. Your average risk reward is 1.7. You've run that math enough times that it's automatic now. Over 100 trades, a 51% win rate at 1.7 generates consistent positive expectancy. You know that a losing streak of 8 to 10 trades in a row is statistically normal and not a sign that the strategy is broken. You've had 2 of those streaks this year. You took them the same way, reduced position size slightly, kept taking the setups, waited for mean reversion. Both times the equity curve recovered. Monthly income from funded accounts last month, $3,800. Profit split at 80% across $130,000 in capital at 3.6% return. You still have the day job. You're seriously thinking about leaving it. Your trading income is not yet consistent enough month to month to fully replace it. Some months it's $900, some months it's $5 to $100. That variance is the last thing standing between you and full-time. You're working on it. Specifically, you're working on your drawdown months. Not how to prevent them, but how to recognize when you're in one early enough to size down before it compounds. At stage 4, the bank statement looks like a second income. Inconsistent but real. Growing but not yet reliable enough to bet your life on. Stage 5, you've been trading for 5 to 7 years. You manage funded accounts totaling $280,000 in capital. You left the day job 14 months ago. Your monthly trading income averages $7,400. The accounts are now split across 4 firms: FERTMO, Funded Next, MyFundedFX, and a newer firm with favorable scaling terms. You diversify across firms the way you diversify across setups, not because you distrust any of them individually, but because concentration risk is concentration risk regardless of the asset. You've seen prop firms close. In 2024, over 80 prop firms shut down, some suddenly, some with notice, some with disputed payouts. You keep no more than $100,000 of your funded capital at any single firm. This is a rule you made after a firm you weren't using went under and you watched other traders lose access to accounts they'd spent years building. Your monthly income has real structure now. $280,000 at an average monthly return of 3.3% is $9,240 gross. After profit splits averaging 80%, you take home $7,392. Taxes you've set up properly with an accountant take 22%. Net monthly, $5,766. Some months it's $4,100, some months it's $9,800. You don't spend to the upper end of the range. You spend to the lower end and invest the difference. The variance is no longer frightening, it's just variance. You've experienced enough months to know the distribution. You track the account in a spreadsheet updated every Sunday. Not daily. Daily tracking creates emotional noise that degrades decision-making. Sunday is enough. If the equity curve is trending correctly, you trade the same way next week. If it's degrading, you reduce size and review the journal for systematic errors before anything else. At stage 5, the bank statement looks like a salary from an employer who pays inconsistently but on average well, and whose demands on your time are 15 to 20 hours a week. You're not rich, you are free. Stage 6, you've been trading for more than 8 years. Funded capital across multiple firms exceeds $500,000. Your trading generates $12,000 to $18,000 per month. You've stopped counting it monthly, you count it quarterly now. The shift from monthly to quarterly accounting happens when the monthly variance stops mattering because the quarterly outcome is always above what you need. Your fixed expenses are $4,200 a month. Your trading income, even in a bad quarter, covers that twice. You stopped watching the money closely because you don't need to watch it closely. The account does what accounts do when you've spent 8 years learning how to run them. You teach now, not as a primary income, as a natural extension of understanding something well enough that explaining it to someone else is no longer effortful. You run a private group, 43 traders, you charge $300 a month. That's $12,900 a month, nearly matching your trading income, working 12 hours a week. The combination of trading income and teaching income produces $25,000 to $30,000 per month. The diversification wasn't planned, it emerged from competence. The bank statement at stage 6 doesn't look exciting. That's the thing nobody tells you. There's no moment when the number changes so dramatically that it feels like arrival. There are just months that are better than the month before, and then years that are better than the year before, until you look at the statement and recognize a number that would have seemed impossible to the person who opened that first $1,000 account and lost $47 in 11 days. What changed between stage 1 and stage 6 is not strategy. The strategy most profitable traders use is not complicated. It is not secret. Anyone can find it. What changed is the person running it, the emotional architecture, the position sizing discipline, the ability to sit with a losing day and not respond to it, the willingness to track every trade, review every month, and make changes based on data instead of feeling. Between 74% and 89% of retail Forex accounts lose money. That figure is required by law to appear on every regulated broker's website in Europe. It appears in the fine print. Most people skim it. The traders who stay past stage 2 read it carefully, not as a warning about the market, but as a description of what they need to become different from. The bank statement is always honest. The chart can be edited for a screenshot. The equity curve can be cropped. The withdrawal history can't be faked. Everything you need to know about where a trader actually is lives in the statement, not the setup. Open yours. Read it the way a trader reads a chart. What is it telling you?